If you had asked this question during the crypto rally in 2021, you would have gotten a blatant no or a partial "you can still try" as a reply. Okay, that was then. What about now? Back in January, if you can still remember, on one of American television's biggest nights with 99 million viewers, the Super Bowl broadcast was punctuated by a series of cryptocurrency advertisements. Social media buzzed incredibly with talk on how digital tokens had come of age as they grabbed primetime slots previously taken over by mainstream giants like Coca-Cola and General Motors. On that night, one of the advertisements had comedian Larry David playing a Luddite, dismissing humankind's biggest inventions, from the wheel to Edison's light bulb, which the commercial suggested as the FTX cryptocurrency exchange. It was told that the platform is a safe and easy way to get into crypto. David's character said, I don't think so, and I'm never wrong about this stuff. Well, that advertisement hasn't aged well. Recently, experts told Al Jazeera that cryptocurrencies will probably survive, but they won't be void of the difficulties. It was noted that the sector will likely face increased regulation and an extended period of uncertainty. Many firms and currencies will perish, and to stay alive, companies will face one challenge above all, which is winning back customer trust. Right now, everyone is keeping their heads low, refraining from risk assets. It will take a long time to convince them to come back, and even a meteoric rise might not quickly do the trick. Cryptocurrency trading platforms have traditionally drawn in customers with the promise of quick returns on investment and other mouthwatering offers. For those who are distrustful of traditional finance, the opportunity to carry out transactions without worrying about a regulator as an intermediary is an added attraction. However, disaster struck and this allure dimmed once the US Federal Reserve and other major central banks around the world sharply raised interest rates throughout 2022, making more traditional investment options more lucrative than before. A notable example is the US rate, which shot up by more than 4 percentage points throughout 2022. This is a comfortable point to ask what attracted you to crypto. There were other things that impacted this as well, such as Terra USD and Luna that went into freefall, and a combination of safer alternatives and reduced trust in crypto led to a crisis. And from what we can tell, it's far from over. I think we'll see a lot more bad news before things start looking better for the sector. Director of the Computational Finance and Risk Management Program at the University of Washington in Seattle told Al Jazeera. Well, with many potential customers now skeptical, crypto platforms will likely witness low trading volumes for a while. Others remain hopeful that crypto, with its potential to enable peer-to-peer decentralized financial exchanges, represents a transformational technology. The technology is here to stay, even if a number of the initial projects in the crypto space are falling, MIT's Catalini noted. He further described the moment as similar to the dot-com bubble that burst in the late 1990s when many early online firms went bust. Those like Amazon that survive or came up later are among the internet giants of today, he said. Still, until the dust settles and reliable regulations come in, Leung at the University of Washington said it's best to be cautious. Yes, cautious. You don't want to make decisions based on Super Bowl commercials. This isn't a game, he said. The decline of the crypto market has been expected, especially for top digital assets such as Bitcoin, Ethereum, and Cardano. The fall has hit the market hard, especially with the collapse of one of the leading DeFi protocols, the Terra network. We can't get enough of this devastating story. However, JP Morgan CEO Jamie Dimon believes that it is only the beginning. Despite the market is more than 50% down from its all-time high, the bank executive says that there are worse roads ahead. Is this a lack of faith or a deliberate hit at the historically risky market? Oh yeah, and before we forget, Jamie Dimon has not been the best supporter of cryptocurrencies in general. Nevertheless, the bank which he heads as CEO, JP Morgan, has been steadying its stance toward digital assets and has moved forward with various strategies to provide its customers with cryptocurrency trading options. With the crypto market, and given that there is now exposure to the market to a certain degree, Dimon has come forward to explain that the bank is expecting more decline. Dimon has advised cryptocurrency investors to brace yourself as he expects exacerbated market volatility. This is because the Fed will begin implementing its quantitative tightening policies, which will see the Fed removing liquidity from the market. I said there are storm clouds. They're big storm clouds here. It's a hurricane, and that hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy, he warned. Nonetheless, the crypto crackdown is on, and complaining about it will not make it stop, but smart innovation will. It is comfortable to say that the crypto space is in the middle of a crackdown, with the Commodities and Futures Trading Commission joining the Securities and Exchange Commission by suing both Binance and CEO Champagne Zhao on multiple counts. Various advocacy and trade groups have expressed ongoing outrage, disappointment, and general discontent with the current state of the crypto regulation in the United States. This reaction is quite expected, but will absolutely not do anything to mitigate what seems to be a deterred effort by regulators such as Gary Gensler to single-handedly enforce rules through an avalanche of enforcement actions and court cases. Well-meaning organizations, including Coinbase, which spent millions of dollars and years of management time proactively engaging with regulators and policymakers, find themselves lumped in with bad actors as the shadow of FTX casts doubt over the entire sector. In an additional blow to the industry, the collapse of Silicon Valley Bank and Signature Bank and general banking fears at large have formed a major part of the crypto winter. Also, some of the more blatant speculation and get-rich-quick products that proliferated during the bull market of 2021 did not endear the sector to policymakers or regulators, thus leaving a sour taste for many. So it has been a difficult year for crypto investors, especially those who are hanging on to Cardano, which has been labeled as a ghost chain. But the Cardano founder, Charles Hoskinson, just said something about ADA. Recently, weaker investor sentiment has prevailed in the crypto market, leading to more liquidity outflows for most top projects. However, in an interview, Charles Hoskinson weighed in on these conditions and provided his predictions for the future of crypto. Speaking during the interview, Hoskinson acknowledged that the crypto market has been recovering from its bearish performance in 2022. He said this despite the recent market slowdown. The founder believes it was better to be in the crypto right now than a banker, considering the ongoing banking contagion. His claim suggests that there was more loss of confidence in the banking sector at a time when crypto projects continue to build, and Cardano itself is not left out. Charles Hoskinson also gave his 2 cents on the state of crypto regulation. He acknowledged the convoluted state of crypto regulation in the United States as one of the key issues contributing to the current market uncertainty. Hoskinson mentioned that many crypto projects are shifting their focuses abroad. Cardano continues to face growth despite going through yet another wind of uncertainty. The network has maintained healthy development activity in the last 4 weeks. However, investor sentiment wavered during the same period. Furthermore, Cardano ADA, just like most cryptocurrencies in the market, witnessed a downfall in the past few weeks. However, according to Sebastian Guillemot, co-founder of DC Spark and contributor to the Cardano platform, Cardano load stood at 94% recently. Cardano is currently at 94% load, only 6% left until Cardano is at max capacity. What does that mean, and how can you be prepared? He tweeted. The Cardano contributor explained that all transactions on the network were processed on a first-come, first-served basis, but upon hitting 100% load, transactions will be queued up and many users will have to wait for their transactions to go through. In addition, the higher the load after 100%, the longer the transaction wait time. Another outcome of the load hitting 100% would be that the stake pools could sell priority access to users and dApps. They may also reach a point in which they could prioritize one DEX over another. This might not sound pretty, but it's safe to consider the most recent strides in Cardano as outstanding leverages that would make the token worth holding. Cardano investors are indeed pulling out the plugs, and various warnings from various crypto watchers aren't helping either. But regardless of the negativities, many still need reasons to keep holding ADA. It's not too late to buy Cardano ADA, and if you buy now, then you'll be one of the graceful partakers of the famous narrative. The patient dog eats the fattest bone. But that's going to do it for today's video. Make sure you hit the subscribe notification buttons, and we'll see you in the next video.